What's up, guys? Your agent Tyler Wehrung here with Keller Williams, and today we're going to talk about the differences, pros and cons of 15 and 30-year mortgages. We get this question a lot, kind of which one's better, which one best fits my situation, and we often hear a lot of advice around here that isn't very sound or isn't the full picture. So we want to jump in and give our thoughts and just give you some different ideas of things to dig into. Nothing that we're going to tell you about here is specific investment or tax related advice. Always recommend you talk to a tax professional or a financial consultant before you make any investment or tax related decisions. All right, so with that, let's jump in. Alright guys, so just to start off, we're going to do things a little bit different here. I'm going to do some screen sharing so you can see some of the tools that you might be able to use to move the numbers around to be more specific to your situation, and I highly recommend you do that. I'm also going to show you a couple hypothetical examples to give you a different perspective here. So we're going to start out kind of just talking about the pros and cons of each with a example here that we pulled out using a $200,000 purchase price, putting a 10% payment down or $20,000 and for a $180,000 loan amount. So a primary difference between a 15 and 30-year mortgage, aside from the term of the loan, is typically you get a discounted interest rate by going with a shorter duration loan amount, shorter loan term. This is a better risk profile to the bank. They're getting paid back sooner, so for that benefit, they're willing to give you a slight discount on the interest rate. So these examples here we pulled from Bankrate.com, and I'll show you how to do that in just a second. But for a 15-year loan, we were right at 2.5 compared to 2.875 for the 30-year counterpart. So you'll see in the column F here, we've just highlighted the differences between everything. So the difference, 0.375 discount on the 15-year loan. So what that means is you will get a discount, but since you're cramming all those payments into a shorter time frame, your total monthly payment will be significantly higher. In this case, it's $450 more, from $746 to $1,200. And the primary benefit to the 15-year mortgage, and the most often quoted number when talked about it, is the amount of interest saved. So since you're paying it off in a shorter duration, you're not making that second 15-year, that second set of 15 years after. You're not making 30 years worth of payments. You're only making that first 15. So in this situation here, total payments go from $269 down to $216, which is a total interest savings of $52,971. Now, this is not an insignificant number, but we often hear about, you have to go with a 15 because you're saving almost over $50,000 in interest. But we feel like that's really not the whole story. So I want to show you a couple different things here to give you a different perspective and find out which decision is right for you. So like I mentioned before, we're going to go over here and show you some tools that we use. Start off with a Google search here, Bankrate mortgage rates. We recommend Bankrate all the time. They're pretty non-biased, although they do obviously have paid advertising and promote certain banks on their site. They typically will give you a good idea of what the market is looking like, and especially in your area. However, if you do try to move forward with these, expect a lot of phone calls and emails. We use this more for high-level informational, just on what the market's doing. But if you decide to move forward with one of these lenders, I would personally reach out to them outside of this site, or find a local lender in your area. So as you can see up here, you can play with the numbers to get them to your specific situation. Let's see here, we did 180,000. I have this pulled up in a separate rate, but I just wanted to show you how we found that. So in a separate tab, we pulled this up, $200,000 purchase price, 10% down. And then when you're looking at rates, this is the 30-year example here, you want to always find and compare things that are apples to apples. So when you see points, if you hover over this, a point basically is you buying down the interest rate. So you're paying an upfront fee for a cheaper interest rate. So we can shoot another video on that if that's something you're interested in. But when you're looking for these, we typically just look for 0 points so you can get a good feel of kind of what the market rate is. So for the 30-year loan, we went with 2.875 for our example that you'll remember over here, 2.875. And then to find the 15-year counterpart, you would just do this. I'll save you the time here. It basically, we found it was 2.50. All right, so Bankrate also has a good calculator. Again, Google is your friend here. Bankrate mortgage calculator, first thing that comes up. We already had this pulled up as well. Basically, you can come over here, input that same information, home price, down payment, 30-year. You can adjust this if you'd like. But what we found, putting this in, it will give you, now just a precaution here. So you'll see here it said your estimated monthly payment, $1,078. But if you look down here, it has your payment here at $746. So this is strictly principal and interest payment here, and this is right off the amortization table. We can also talk more about amortization in a video if you guys would like, but essentially it just shows, if you pay attention to the green and red, you'll notice over time they kind of are inversely proportional, in that in the beginning you pay a higher percentage of your total payment is interest compared to principal, and then over time they kind of flip-flop, and at the end a bigger chunk of your payment is principal and less of it is interest. That kind of makes sure the bank gets paid kind of their big chunks of their money back in the beginning of the loan, and then in the last half of the loan is where you're paying bigger chunks of principal off. Anyway, just want to highlight, when you're comparing things, just compare principal and interest payment. Your taxes and insurance will be the same regardless. So look at there, and for $746, you'll notice that's what we use for our 30-year monthly payment here. And to do the same for the 15, you simply just change the drop down. It recalculates everything into excuse me, 1232. Might have changed something accidentally here. Yeah, we had 1200. So that is okay. We're $30 off in the benefit of the 15 years. So I think that's fine. This will just be a more conservative example of kind of what we're hoping to show you here. So, all right, you can also use this to find, if you scroll all the way down, you can find, see total payments, as of, the end of the loan and things like that. What we've done is put them in a nice graph here, actually over here. All right, nice graph. Okay, so this is your total investment kind of per year. So, the gray line is the 30-year, obviously, and the orange line is your 15-year. So at the 15-year mark, you're paying back $216,000, and that's your total investments. You'll see no more contributions after that, whereas the 30-year shows, going all the way out to that full 30th year. What I want to call out here is, you'll notice this green bar is where these two lines intersect, and that is at the year 25. So what this is telling you is that a 15-year loan, since you're making such higher payments in the beginning, it really doesn't pay off until year 25, or not pay off, but it isn't the same contribution amount until you cross that year 25. So that's something that people often don't mention, and I think that's something that you'll definitely want to consider when kind of putting so much in the beginning towards that mortgage. So If you're truly looking at numbers and from a savings perspective, you could say that, and this is an example we did. So you're saving, if you'll remember, on a 30-year mortgage, you're saving $454 a month, and that's noted here. What if you invested the difference throughout the duration here for the first 15, or actually the first 25 years? Would you be better off? So folks often assume that just the interest savings alone is the primary benefit, but what if you went the 30-year route and invested the difference? So I want to show you something. If you're not familiar, compound interest calculator. If you're not familiar with compound interest, let us know. We can shoot a video on that, but it essentially just means over time things compound and become they kind of double and grow over time. Let's see here. I think their minimum is 100. We put down here, all right, 454. If we put the difference if we went with a 30-year and put the difference into an investment account for that first 25 years here. Sorry, it won't let me punch this in. Oh boy, hit it too many times. Oh, we're still going. Sorry, guys. All right, so if we invested this in, kind of comparing it back over here, if we're going to compare at the first 25 years or when our investment contributions would be the same, what if we instead went with a 30, took the difference and invested it into kind of S&P 500 index fund, and just for example's sake, average investment return of S&P historically. So you'll see approximately around 10 to 11%. Some will say 13. For a conservative example, we'll say that we'll just call it 8. What if you could get an 8% return on this extra money that you put in the bank? This kind of shows you what that could grow to just in that same 25 years. So rather than that example where everyone cites you could save this $52,000 in interest. So what if instead you took that difference and invested it in the S&P 500 index fund? You would have an account with $399,000. Now, to be fair, if we did the same thing starting from year 16 and invested the entire principal payment, $1,200, to year 25, you only get $180,000. If you're familiar with the principles of compound interest, it's over time is when you get the true benefit. So the difference here is $219,000, comparing the 30 from the beginning to year 25 from comparing that to the 15 starting at year 16 to 25. And then we did the difference of what if we stretch that not to 25, let's stretch it all the way out to the end of the loan. As you can see here, anytime you're dealing with compound interest, typically the earlier you start and get that momentum going, the bigger the snowball rolls down the hill. So even starting from the very beginning, rolling it out to the end of the loan, you have a difference of $226,000 in benefit of the 30-year loan if you were to put this into an investment portfolio. So another way of looking at this is, if you truly want to look at it from a mathematical standpoint, which most personal finance decisions are behavioral rather than mathematical, but I think when folks often quote the 15, they're using strictly a math approach, talking about the interest savings alone. The best mathematical approach would be to go with a 30-year, invest the difference up to year 13. We did the math over here. At year 13, your principal pay down, or your total investment here of principal pay down would be $116,000. And if you had built this investment account up at year 13, you'd have $117,000 in here. So those two together would be enough to pay off the loan and you would do it, I think it's between year 12 and 13. So that would actually allow you to reduce another 2 years off the 15 if you wanted some combination. So again, this is just to kind of give you different thought patterns around not just going with the advice that you often hear touted and the numbers that are thrown around often. So another couple things to think about. This is early 2021. We're at historic low interest rates. And so the higher the difference between the two will definitely factor into the math involved. And another thing, guys, while this $52,000 here in interest that you're going to be paying extra on a 30-year, while we never recommend that you make investment decisions based on the tax implications, as the saying goes, you don't let the tax tail wag the dog. This is all interest that you are able to write off as a mortgage interest tax deduction. So this could benefit you from an overall reducing your overall taxable income. Again, it talks with your tax professional about your specific situation. But again, this isn't like you're just throwing $52,000 in the garbage can. This could be a benefit that you're able to write off on your taxes as well. But one last piece that I'll leave you with is that we often also use this number of 52,000 and don't consider that it's over a 30-year period. So another thing that we often look at is in inflation. So in 30 years from now, inflation is going to erode that monthly payment by a pretty significant amount. You can kind of play with these numbers here, but I think we were saying here, let's call it 52,000 in 2050 dollars is really only 25,000 in today's dollars. So kind of said the other way, or if we look at it from a monthly payment perspective, $746 is really, in 2050 is really like the same as us paying $365. So you're locking in a payment today, and then appreciation or inflation then becomes on your side because your monthly principal and interest payment doesn't change over that time frame, but inflation, your dollars become more powerful, which means it takes less of them to make that monthly payment. So that's another feather in the hat for the 30-year fixed interest rate loan option. The thing that we often see folks get stuck in, they feel like they're making the more responsible decision by going with a 15-year loan, and in most cases they are. But then something happens down the road. They lock themselves into this higher monthly payment, and then things like the coronavirus hits, maybe a job change, maybe a job loss happens, and they think maybe I can go to the bank and tell them, hey, I tried to do the responsible thing, but I can't make this payment, and that's not how it works. Once you sign the loan docs, you are locked into that monthly payment at that amount. You can't go back and say, oh, let's back it off, I'll do the 30. It's really only an option in the beginning. So when you do a 15, you're committing to that full monthly payment for those full 15 years. And we just see a lot of folks get stuck there. So if you decide to do that, make sure even with the 15, you have plenty of cushion in your budget. You have some flexibility and maybe a good emergency fund for things that could come up. We typically push people in the direction of 30-year, especially if they're first-time home buyers and are new to the whole process and are early on in their career and not really sure what the next 15 years even looks like for them. So this just gives you more flexibility. If you have extra, you can always pay down principal or put it in an investment account until you have enough to pay off the mortgage, if that's your end goal at all. So I hope this was helpful. I hope this really gives you some insight into different things to think about as you're kind of weighing out your options. Highly recommend you check out or put specific figures into Bankrate to kind of see what what's best for your situation. But just think through all of the different aspects. Don't just ask folks on the street that you run into that can just spit off figures that they've heard other folks talk about. So again, I hope this was helpful. Please share if it was, anyone that you think might get value from it. We would highly appreciate any subscribes or likes on the video. Comment below if you have any questions about something we did or why we did something a certain way. I'd be more than happy to explain that, or if you have questions or want a deeper dive into a particular subject, like I know we talked about amortization, compound interest, things like that. Happy to do those if you guys would get value from them. Again, Tyler Wehrung with Keller Williams, and we'll catch you next time. Thanks, guys.